Okay, let's unpack this. When you think about global markets, I mean, the U.S. share market really stands out, doesn't it? It's this dynamic, fast-moving place investors look to for growth, for diversification.
Absolutely. It's just a huge center for capital, for innovation. I mean, the companies listed there really do shape the global economy. So understanding how it works is, well, pretty crucial for anyone involved.
And that's exactly what we're trying to do here in this deep dive. We've got this really comprehensive guide in front of us, all about navigating the U.S. market. Our job is to pull out the key insights for you.
Yeah, and this source is useful because it hits the fundamentals, the exchanges, the rules, but it also gives us a snapshot, sort of an outlook from right now, mid-2025.
So you get the basics and current state of play.
Exactly. Timeless principles, current context.
All right, let's jump right in. The absolute foundation. Where do these stocks actually trade?
Okay, so the source lays out the main places. You basically got two major exchanges, and they're quite different in character.
First up, the big one everyone's heard of, the New York Stock Exchange, the big board.
Right, and the source really highlights its sheer size. It's the world's largest by market cap, something like 3,500 companies listed. It's known for that, traditional auction-style trading floor.
Even though most trading is electronic now, right?
Oh yeah, tons of it is electronic. But it still had that image, and the source points out it's home to a lot of older, established blue-chip companies.
Okay, and then you contrast that with Nasdaq.
Very different feel. Nasdaq is all electronic, always has been. The source notes it's the second largest exchange, and it's really strongly linked with technology companies, growth stocks.
A completely computerized system, revolutionary at the time, I guess.
Definitely.
And the source suggests this difference matters, right? It's not just trivia. Knowing NYSE versus Nasdaq tells you something about the company type.
Yeah, sort of a quick heuristic. NYSE often means established, maybe industrial. Nasdaq often signals tech, innovation, growth. It's just the first step in knowing where to look.
Okay, so that's where they trade. But how do you get a quick feel for how the whole market is doing? Or specific sectors, that's the indices, right?
Exactly. The indices are like market snapshots, benchmarks. The Dow Jones is probably the most famous one globally.
Dow, yeah. Always in the news.
And the source describes it as tracking 30 big, well-known U.S. companies. It's price-weighted, which is a bit different. Basically means higher-priced stocks move the average more. It reflects those sort of industrial giants.
But lots of people say the S&P 500 is actually a better measure, a broader look.
Yeah, the source agrees. It calls the S&P 500 probably the best gauge for large-cap U.S. stocks. It tracks 500 companies, so it's much broader. And crucially, it's weighted by market cap, which most pros think is more representative.
That's the one professional investors watch closely then.
Generally, yes. It's the main benchmark.
And Nasdaq has its own indices too.
It does. There's a Nasdaq composite, which includes, well, every stock on the exchange, thousands of them. But the source specifically pulls out the Nasdaq 100. That one tracks the 100 largest non-financial companies on Nasdaq.
Ah, so non-financial is key there.
Right. And given Nasdaq's heavy tech weighting, the source says this index is, a really important indicator for how the tech sector specifically is performing.
So for you watching the market, these indices, the Dow, S&P 500, Nasdaq Comp, Nasdaq 100, they're your quick checks. Different lenses on how various parts of the U.S. market are doing.
Exactly. From blue chips to broad market to tech leaders.
Now, underpinning all of this activity, there has to be some kind of structure, some rules, regulation.
Oh, absolutely.
Yeah.
It's not the Wild West. The source emphasizes there's a pretty robust regulatory framework. The main player at the federal level is the Securities and Exchange Commission, the SEC.
Right, the SEC. What are their main goals, according to the source?
Well, it's kind of threefold. First, protect investors. Make sure companies give out accurate, timely info, and that brokers treat people fairly.
Okay, investor protection number one.
Second, help businesses raise capital. Facilitate capital formation, they call it. Make it possible for companies to access public money.
Makes sense. You need companies to be able to list and grow.
And third, just maintain fair, orderly, and efficient markets. Keep things running smoothly and reliably. The source portrays them as the primary watchdog.
And it's not just the government. The source mentions other groups too.
Yeah, it also points to self-regulatory organizations, or SROs, like FINRA, the Financial Industry Regulatory Authority. They're the ones who directly oversee the broker-dealers, the firms you trade through. They handle licensing, rules, compliance, that sort of thing.
So it's like industry policing itself, but under the SEC's overall watch?
Pretty much. It's It's an extra layer of oversight.
And the source implies these regulations are crucial for trust, right? Especially for investors coming in from outside the U.S.
Definitely. That feeling of a level playing field is important, which actually leads us nicely into the next point. How do global investors get involved? How do you access this market?
The source suggests it's actually gotten a lot easier over time.
Yeah, much more straightforward now. The typical route involves a few steps. First, you need to choose a reputable broker. The source says lots of international brokers now offer pretty seamless U.S. market access.
So finding a broker is step one. Then what?
Then you got the usual KYC process. Know your customer. You'll need to provide ID, proof of address, tax information, standard stuff for financial accounts.
Right, the identity checks.
And then finally, funding the account, transferring money in. The source mentions brokers usually have options for handling currency conversion and making deposits relatively easy.
Okay, so broker, KYC, funding. But the source also highlights you don't have to just buy individual company stocks, right?
That's a really key point. Exchange-traded funds, ETFs, are huge now. The source describes them as basically baskets of stocks or bonds or other assets that trade on an exchange just like a single share.
So you get diversification easily.
Instantly. You can buy an ETF that tracks the S&P 500 or one focused on a specific sector like technology or healthcare or even different investment styles. It's a very accessible way to get broad exposure.
And index funds are similar.
Similar idea, yeah. Often they're structured as mutual funds rather than trading quite like stocks during the day, but they also aim to track an index and give you that broad market exposure. The source sees both as tools that really lower the barrier for entry and diversification.
So these are the practical tools and steps you can use to actually participate in the U.S. market.
Exactly. The how-to.
Okay, we know the structure, the benchmarks, the rules, how to get in. What actually moves this giant market day to day, year to year? What are the big influences?
The source points to several key factors. First, just basic economic growth, GDP numbers, consumer spending trends, how much businesses are investing.
If the economy is strong, markets tend to do well.
Generally, yeah.
Yeah.
The source links that to positive sentiment, but also, more concretely, to stronger corporate earnings.
Earnings. That feels like the most direct connection. Company makes more money, stock price should go up, theoretically.
Absolutely. Earnings are fundamental. But the source also really stresses the impact of interest rates, especially what the Federal Reserve does.
The Fed, always a big focus.
Right. Lower rates tend to make borrowing cheaper for companies and consumers, which can boost spending and investment, potentially lifting stock prices. Higher rates do the opposite, make borrowing expensive, potentially squeezing profits.
And inflation, that seems to just complicate everything.
It does. The source notes high inflation eats away at purchasing power, can hurt company profits because costs go up, and just generally creates uncertainty of the future. Harder to value things.
Then there are the things you can't really predict easily. Geopolitical events.
Total wild card, yeah. The source mentions things like global political shifts, trade policy changes like tariffs, which are a factor now, and obviously international conflicts. These things can inject a lot of volatility, shift sentiment really quickly.
And we can't forget technology's role.
No way. Innovation, especially in tech, is constantly creating new industries, disrupting old ones. That drives huge shifts in the market, creates new opportunities. It's a constant force.
So the source paints this picture of interconnected forces: economy, earnings, rates, inflation, politics, tech, all swirling around and influencing your investments.
Exactly. Understanding these helps you understand why the market moves.
Which brings us to the source's view of things right now, mid-2025. It calls the picture complex.
Yeah, it's not a simple story. It notes that, okay, broad indices like the S&P 500 have made gains, but the source flags the potential for volatility to actually increase from here.
So not just normal volatility, but maybe more bumps ahead?
That's the suggestion, and it dives into valuation. Based on some analysis the source looked at, it suggests there might be, let's say, a minimal margin of safety at current market levels compared to the risks.
So potentially stretched valuations in that view?
That's one interpretation presented, yeah. And the interest rate situation isn't resolved. Rates might have stabilized, but the source stresses they're still elevated. That could keep pinching companies, especially smaller ones needing to borrow.
Right, higher borrowing costs stick around.
And inflation worries haven't totally gone away either. The source connects this to things like potential tariffs, suggesting these pressures could continue, maybe leading to more price increases, another layer of uncertainty for businesses and investors.
What I found really interesting was the source's specific comments on different sectors or types of stocks right now, the valuation differences.
Yes, that was quite specific. It notes that as of mid-2025, based on its analysis, value stocks companies may be seen as trading cheap relative to their assets, or earnings appear to be at a discount.
Okay, so value potentially looking attractive according to this source. What about growth?
Growth stocks, often priced on future potential, might be trading at more of a premium, the source suggests, maybe reflecting optimism about their future, but perhaps less of a bargain now.
And small cap stocks, the smaller companies.
This was maybe the most striking point. The source highlights that small cap stocks seem to be trading at a significant discount compared to, say, large caps. It explicitly suggests this could present opportunities for investors with a long-term view.
Interesting. So a real divergence in valuation across different market segments, according to this guide's mid-2025 read. That's a key takeaway for you considering the current landscape.
Definitely a granular insight.
Yeah.
So wrapping this up, the U.S. market is, well, clearly dynamic, complex, and the source is careful to remind us investing always involves risk. Values go up and down, no guarantees.
Yeah, and the source really hammers home the need to do your homework. Conduct thorough research, really understand your own comfort level with risk, and importantly, consider talking to a qualified financial advisor before jumping in.
Sound advice. It all ties back to why we do these deep dives, right? To help build that understanding from the analysis that's out there.
Absolutely. And to leave you with something to think about, building on that nuanced mid-2025 picture from our source. Given it specifically pointed out those different valuations, value stocks at a discount, growth at a premium, and small caps at a significant discount right now, which of those specific observations feels most compelling or maybe raises the biggest questions for your own understanding of today's market?